What in God's name do cycles say now about our enjoyable inflation?
Up, in a word.
We're going to see a 4% print on CPI.
Well, directionally, we're headed in the upward direction. And the interesting thing is that it's emphatic on the U.S., and it was pre-war. It's happening in Europe. It's happening in Asia, in Japan. And so I was listening to your segment before on currencies, right? Mm-hmm. Look, everybody's, whether they know it or not, their underlying inflation cycle is up. And so it's all relative after that. And you have cycles in inflation, and of course you have cycles in growth. Now, the U.S., it's true. We're knocking it out of the park, right? I've been saying, hey, there's no window of vulnerability. I've been super consistent on that, including around the Iran war. And that continues to be the case. And underneath, it gets a little messy. It's a K-shaped economy underneath. The pain is real on the lower end of the K. They're really getting squeezed by the higher prices. Mm-hmm. What's going to happen here, I think, is quite interesting because we have our cyclical view, Tom, that you're saying, what the heck do cycles say? So you have this near-term cyclical view. That's what the snapshot is. But then you look at the patterns of all the mistakes in reading the cyclical stuff. And there is a hope that oil comes down, and sure, I hope it does too. Let's say it. Let's insist that it will. The price of oil will come down. So you've got then everybody says it's temporary.
Jeffrey Moore has never faced these unknown unknowns that we have right now.
Well, no, I don't think that's true. We've faced them, and we've seen the misread on the cycle time and time again. In 2007. The Fed thought that stimulus had headed off a recession. Inside of a recession, 6 months inside, the Fed led the market to price in 100 basis points of hikes. That's a huge mistake. The cycle read that thing perfectly. In the middle of the teens, 2015, 2016, the Fed thought, hey, structural healing is done. We could start raising rates. Dead wrong. The FIG read that very clearly. Remember COVID 2022? That was the famous, it's temporary. It's transitory was the word. Don't worry about it. No, the FIG nailed that thing. And the Fed was so late, they didn't start hiking until March of 2022. What a mess. Mm-hmm. Now, what did they learn from all this? This is the amazing part. Later on, they do a big investigation for a couple of years, and they believe that skilled monetary policy had caused structural downshift in inflation. And so that's why they could leave it transitory. That's kind of a bonkers conclusion, quite frankly. Mm-hmm. Cycles happen no matter what. And so right now, what I'm worried about is we're either going to get the Maestro, right, the 90s, which is fun, or we're going to get Burns, which is the 70s, which is not fun.
You're the first person. This is brilliant.
Okay.
We're going to get Greenspan or Burns.
and I'm not sure who, right? I got to watch the FIG. Right now, the FIG is saying up. Let's say Warsh wants to, as soon as he can, cut if oil comes down or if AI productivity comes.
To interrupt, and you know this well because you live over there half the time, are we going to get Mervyn King where the governors and presidents tells Chairman Warsh what to do?
I don't think so. I think there's a huge political pressure. That's why I'm a little worried about the Burns situation. If you have the FIG going up and you have huge political pressure to not hike, you get a lot of volatility because you have, if you make a mistake on policy on a cyclical basis, it doesn't smooth the cycle out. Right. It makes the cycle bigger. And so that's what I'm worried about. If Warsh starts going toward, or the Fed starts going towards hikes and cuts, and the FIG is still going up, buckle your seatbelts. That's going to get bouncy. Yeah. But it could get bailed out if the FIG turns down. And I don't know. I don't predict the predictors. If the FIG should turn down, then you might get the Maestro. It'll look like the Maestro. The mistake here is if oil comes down, it doesn't mean an all clear. Look at core. The FIG is looking at the cycles in core. And if core keeps moving up, which is it is doing in the U.S., it's doing it in Europe, and it's doing it in Japan. Mm-hmm. It's doing it whether you want to watch it or not. It's happening. And that's the risk here. And on growth, right now, I've been saying window of vulnerability shut, and that remains to be the case. Long leading indicators of growth, the shine has come off. So that gets interesting later.
So I guess a lot of investors are just trying to figure out how much of this inflation story that we see in the U.S. and around the world is directly from the war in Iran and all the ripple effects versus more underlying stuff.
Great question, and I think everybody's missing the forest for the trees, literally. I think it is not. It's not about oil. Oil is moving the headline around. I think the big mistake here is if oil comes down, let's say the sky's clear, and oil comes down, or it stops rising, and people get used to it and say, okay, we're fine. It's an inflationary boom. We're fine.
Right.
The core is going to keep going up, and that ultimately is a problem. And you see the rate market is starting to try to wonder about this. Real rates are up
So
quite
how do
a bit.
we got to run, Lakshman, but how do you interpret the new rate and the new real yield?
That they're kind of feeling that the Fed's going to make a mistake. They're going to mix up the structural with the cyclical. And that's my fear too, because they've done it 5 times in a row over several decades.
Okay.